Good morning from New York, the Conference Board webcast studios. I'm Ataman Özyıldırım with the Conference Board, and this is your February 2018 edition of the Conference Board's Economics Watch review of the US and global economies. Today we have a special program. First, we're going to talk about, as usual, the global and the US outlook, but we have a special guest who I will introduce in a minute, who will tell us about some new indicators in the services part of the economy, and we're looking forward to having that conversation. Before we get into that, let me just kind of mention our outline for this webcast. Some of the main questions and issues that we're going to address are whether the strong acceleration in the global economy can be maintained in 2018, especially in light of the volatility that we're seeing over the last couple of weeks in the stock markets, and it's been kind of traveling around the world as well. So is that going to damage the 2018 outlook? As I mentioned, there is a new set of legal services activity indicators, which can really help to put a lens on a part of the economy that we don't have a lot of indicators for. And as our viewers know, we track a lot of leading indicators, and in that context, we're going to introduce these new indicators and talk about, what they're telling us about the U.S. economy and whether we can see some responses to changes in policy that's going on. So I think that's going to be a very interesting discussion here in the second part of the webcast. But first, a few tips to help to improve your experience on this webcast. As usual, we like to have these webcasts very interactive. Feel free to ask your questions using the pod on the bottom left corner of your screen, and I'll get them right here in the studio, and I'll be able to weave them into our conversation. You can download the presentation. There's a file download pod in the bottom center of your screen. You can refer back to it, or you can share it with your colleagues at your company. You can make the slides full screen by clicking the four arrows at the top right corner of the screen. That gives you a bigger view of the slides that we're going through. We would appreciate if you could give us your feedback by completing the brief evaluation, a few questions at the end of the webcast. We'll continue to improve the programs for you. Feel free to send in your questions and topics that you might want us to address and cover in future programs as well. And you can share this program on demand with your colleagues. The recording will be available in about 48 hours after the webcast. It'll be on the Conference Board's website. And some of you may be joining us for credits, CPE credits. If you're doing that, we need you to stay with us for the whole course of the hour. You get credit only for live participation. Please put in your name and email address in the space that's provided. And at random points throughout the hour, you will get a pop-up on your screen, and we ask you to click that to indicate that you are staying on for live participation. So without further ado, let me move on to introducing our speakers today. And I'll be your moderator and host. And to my far right, we have Brian Shaitkin, a senior economist at the Conference Board. And Brian is one of the usual suspects on this program. He looks after the U.S. forecast and outlook. Good morning, Brian.
Looking forward to sharing an exciting month in U.S. economic and market news with all of you. Thank you, Ataman.
And despite all the downsides, the volatility makes it exciting. And to my immediate right, we have James Rousseau. Welcome, James. Great to have you here.
Great to be here, finally. Thank you.
And James is the Chief Commercial Officer at Legal Shield. And he's done a lot of work in leading B2B firms in the services area. And you're the author of Success on Your Own Terms.
Correct. Do that in my spare time.
So it's great to have you here. Can you tell us a little bit about what Legal Shield is and what do you do?
Absolutely. Legal Shield is a firm that's been 45 years in existence. We're the largest provider of subscription-based legal services We are based in Ada, Oklahoma, and we really deliver our services through attorneys in all 50 states of the U.S. and 4 provinces of Canada. And we have law firms that represent us in each of those places. It's a proprietary system, which means those law firms operate predominantly for us. We have 1.75 million members today. And during the course of the year, we actually get over 1.75 million intakes, which means members call us that often for that service. We deliver those services both direct to consumers. They can buy our services on websites. We also deliver through network marketing, and we deliver strongly as employee benefits. That's actually last year was our primary mode of sales last year as an employee benefit. And that's what we do. And our primary goal and our purpose is to democratize legal services. Oftentimes when people think of legal services and attorneys, they're often unaffordable, unaccountable, non-responsive, and we want to change those things and make it really possible for people to afford it. So we've made it affordable for people to have access to an attorney.
Very interesting. You have a very direct line into a lot of the legal activity that occurs for households and small businesses as well. Right?
Absolutely, and that's what's really brought this to the forefront, that ability to have that data, because we get the direct call when members have certain issues that we believe tie to the economy very tightly, and we'll show that obviously through the course of this conversation.
Yeah, we're going to see those very interesting indicators that kind of really help to put our finger on the pulse of the economy from a very different perspective than we're used to. So we'll get to that.
Sure.
But first, let's talk a little bit about the global outlook. And the team is working on revising our outlook figures that we put out in our annual global outlook report in November. And in February, we kind of look at the latest indicators and go through a quarterly revision. And here we have a preview of what's going to come out in early March. So we're looking at where the economy is moving into in 2018. Let's start with a question to our audience to get their feedback on what they think about the global economy. So that question, if we can pull up the poll question. You'll see that on your screen. And what region will have the most difficulty replicating the 2017 growth performance this year in 2018? And the options are US, Europe, China, or other emerging markets. We haven't, of course, space to list all of the important economies around the world, but these are the main economies that we see as contributing the most to global growth in 2017 and 2018. And the responses are coming in. We'll give maybe 5 more seconds to give them a chance to respond. Looks like they have stabilized. So let's close the poll and we'll share those. It's interesting that it's evenly spread between Europe and China in terms of the outlook repeating itself in 2018. Maybe not as much enthusiasm about the US. It's 18%, and fewer, 6% for other emerging markets. That's an interesting kind of distribution. I think the Europe and China is very consistent with our view as well, and what we're seeing in the leading indicators. I'm a little bit surprised with the US. In the US section, we'll see how dynamic the US economy is in 2018, and maybe that's the jitters that we get from the stock market volatility. What do you think, Brian?
When you look at the numbers, what you see is that the area that's expected to have the least difficulty replicating its performance is going to be the US, because so few individuals ended up choosing the US. So our members are more concerned with what's happening in Europe and China than they are with what's happening in the US and emerging markets. I think that view holds up pretty well, because the US enters with a lot of business consumer confidence, positive momentum related to the tax law, and increases in government spending that were recently approved by Congress as well. Emerging markets did not perform quite as well as mature markets did in 2017, so maybe they have an easier time in 2018 getting back to or doing better than those 2017 numbers. Whereas in Europe, the performance was so exceptionally strong that it's going to be somewhat difficult to maintain, even though there is a lot of confidence. And in China, you have some of the stimulus measures wearing off. So I think that's why our members may be concerned more with what's happening in Europe and China than the US, but still a strong global outlook overall.
Yeah, so let's go back to our regular slides, and I'll begin with also a question to James. I mean, are you optimistic about the U.S. economy? We don't see a lot of fluctuations in services activity. It's a less cyclical part of the economy. And from where you stand, how does the U.S. economy look?
Yeah, we were talking a little bit about this before we started. I throughout the course of 2017, we held a position that consumers generally were overconfident, we felt, about the economy, right? And coming into 2018, we still hold that position that there's a reason to be confident, but folks are, we believe, overconfident. It's going to be volatile for a while for a number of different reasons, including the stock market that we can't avoid and we see every day, and that's going to continue for some time. The new legislation that is to come will take a while to be implemented, and we have everything happening between subprime auto lending. We have housing starts that we hope will take place, but we have to see and make sure input prices hold and that builders can continue to build. And so there's a lot of things taking place that we'd love to see bear out, but until it bears out, right, I don't think we should be overconfident.
No, that's a good point. There are a lot of good reasons to be kind of optimistic about the economy, and the confidence is well placed. And in addition to consumer confidence, we're also seeing that business leaders becoming sort of more confident about the economy. That's in our CEO confidence numbers. And that's largely to do with the fact that, as you see on this slide, that the 2017 growth ends up higher than what we initially expected. So we were expecting around 2.8% projected a year ago. And the latest estimates show around 3.2% global growth. And that also includes the better performance of US, Europe, and China. So there's a lot of reason for that expectation of the momentum. And we currently project that the global growth will be slightly above that in 2018, about 3.3%. That's a pretty good solid growth rate for the global economy. And as we discussed, there's good reasons for that from the consumer side, from the business confidence side. Energy and commodity prices have improved, but they remain volatile. So the same type of volatility we see in the stock markets, we also see more volatility coming back into energy prices. And that creates more uncertainty about especially exporting countries. And the European recovery has surprised on the upside, and we expect that to continue in the first half of the year. But there's some sort of early moderation in leading indicators for the second half of the year. So overall, it's a more balanced view of a strengthening or robust economy, but not going into kind of a big boost in the economic cycle going forward. The U.S., as you both touched on, does get a boost from the tax policy changes, and we'll see some of those numbers towards the end as well, how that's affecting the U.S. economy. So all in all, there is kind of a good view of the global economy going forward, and the leading indicators kind of summarize that into one number. And we've graphed our global LEI, which is an aggregation of 13 economies around the world, and the annual growth rate against the annual growth rate of global GDP. And you see that strong cyclical pickup there. And that relationship is even stronger when you look at global industrial production numbers. And there's a strong signal for that uptick. And the good news is most of that uptick has been very widespread and synchronized across different economies. As already mentioned, most of the support is coming from US, Euro area, and China leading indicators. Other emerging economies were softening slightly, so we did have a little bit backing off in their performance, but they've come back. And the leading indicators suggest that China and the emerging group is actually going to help the global economy, even though we might have some kind of pulling back from the mature economy side. So this chart is a nice kind of separating out the emerging group and the mature group. The dark line is the global GDP growth, year-over-year growth rates. And we do kind of expect through the course of 2018, the contribution of mature economies is going to slightly wane. A lot of that is going to be from the European economy kind of moderating from its recovery. Cyclical recovery will moderate. And even in the U.S., I think it's going to depend, as you mentioned, how some of the new changes will get implemented. And so some of the excitement and expectation might be not warranted yet, and we're not seeing that in the real numbers as much to the same extent. And emerging markets are kind of increasing their contribution going forward. So this slide, I won't go through it, but it does suggest that the first quarter revision of our global outlook is going to be boosted up slightly based on better expectations for 2018. The global outlook will likely move up to 3.3% rather than the 3%, and a pretty widespread upward revisions in many of those economies. So the details of that will be coming out in our March revision.
Ottoman, the equity market declines in the U.S. have been primarily viewed as a U.S.-only phenomenon. It's been generated as a result of changes in U.S. economic variables, but nonetheless, it's been a global event. We've seen stock markets throughout mature markets in Europe, Japan, the UK go down significantly. So the question is, to what extent do these equity market changes potentially jeopardize a brighter outlook for the euro area and our decision to increase our forecasts and our expectations for euro area economic performance in 2018?
Yeah. So the euro area is experiencing this stronger recovery period, and they're going to be maybe lagging the US in terms of the normalization of the economy, the interest rates, but it does kind of put a little bit more pressure on the European Central Bank. When the US Federal Reserve is raising its rates, it'll be harder for the ECB to kind of maintain low rates. They need to kind of keep balances going forward. So I think they will start to normalize as well, and the volatility makes it a little bit harder to see a clear path. So generally, the more well communicated and gradual the changes in those types of monetary policy are, the smoother the transition. But the volatility makes that a little bit harder. And the leading indicators say that there will be some moderation. So maybe they'll be under pressure not to raise as fast. And I think that makes the communication about the rates very difficult as well. But overall, we generally interpret the volatility as showing the fact that the economy, especially the US, but all around the world, is kind of going into a more sort of normal phase. So it's a big change from the period where there was a lot of slack capacity in the economy. And we're seeing this especially in the labor markets with the labor market tightness. The economies around the world are becoming sort of moving above their trend. And that generally puts more upward pressure in inflation, forces the central banks to react by raising rates. And the fact that the interest rates are starting to rise in treasury markets is a positive development in this type of an economy, because it means that there's more expectation of rising rates, and the stock market kind of is affected by that, right? So the stock and bond markets are interacting, And that interaction is creating this volatility, which so far is not likely to damage the economy as much, unless it continues or we continue to see increasing contractions.
And an important point is that Europe is in a different phase of its business cycle, as you mentioned. It depends on which European economy you're talking about. In Germany, you have the same type of tight labor market situation that you do in the US. In France, you do not. And as a result, there are differences in terms of inflationary pressure. Of course, the ECB can only implement one monetary policy to accommodate a diverse range of economies. But I think you're absolutely right that one element for the market concern is that as the Fed increases rates faster, it does build pressure on the ECB to act as well.
Yeah, and not just ECB, also Bank of Japan. Right. So this is kind of the global financial markets, and there are these knock-on effects as we go forward. One thing that I will call out for our audience, and we'll end the global section with that, is that while the euro area economy is doing quite well, their growth figures are coming in better than expected, and we could expect that to continue. The economy of the United Kingdom is showing more and more signals about imbalances forming. And so it's not really synced up with the rest of the European economy. And even before the Brexit vote, there was a deterioration in the leading indicators. The latest LEI for the UK came out this morning. It was down again. So we're beginning to wonder if there's a recession signal forming up there. And that doesn't bode well for the UK. So we kind of downscale our projections for the UK economy. Of course, there's lots more to talk about, but let's now shift to the US, where we have another poll question to ask our audience about the volatility that we've been experiencing in the US economy. So that's about whether you expect the stock prices to recover quickly back to the previous highs and even more, remain highly volatile, about the same levels, not much up or down, and stabilize near current prices, or fall further. So we'll see what our audience thinks about that. Of course, predicting the stock prices is a dangerous game.
Exactly.
You have to be very brave. So give maybe 5 more seconds if anybody changes their minds. I don't see that. So they've stabilized. Let's close the poll and publish the results. And the majority expects them to remain highly volatile, 62%. There are a good sort of a fifth of the audience expects some stabilization around the current prices. Those seem like they're realistic expectations. So in the tails of the distribution, there are some who expect a further fall, and there are some who expect a quick recovery and improvement going forward. As I mentioned, our interpretation of the volatility is so far maybe even cautiously optimistic, that it does reflect a sea change in the economic environment, a maturing of the business cycle, and it has to do with the good expectations, good news that's coming out of the labor markets and the positive impact of the tax policy on the U.S. economy. So overall, we have a slightly sort of positive interpretation of that. But let's move on to our next slide and look at what's going on with the U.S. economy. So Brian, you're following it very closely, and you're constantly thinking about how to revise our numbers. Are we revising them up?
So right now, I think the market volatility that we've seen over the past month has definitely led to a belief that maybe 2.9%, which is our current GDP forecast for 2018, may have been about right for right now. I think to overinterpret the signal that markets are providing that we're going into a period of slower growth would be premature at this point. But I think there's a recognition overall that even though tax cuts add further fuel, both in terms of supporting consumer demand, in terms of income tax cuts, and also on the corporate tax side, certainly there are incentives to invest as a result. Nonetheless, the economy is limited by its capital and labor resources. And one of the reasons we saw markets drop initially was a report that wages had actually started to accelerate. And as a result of that, it's not that businesses are necessarily opposed to higher wage growth, but it was a recognition that given how low unemployment rates are, there are simply a limited number of workers that will be available to businesses. The fact that interest rates also went up, that's a signal that as government and corporate borrowing increase, prices on capital are likely to increase. That's going to be even more true based on the recent budget deal announced in Congress, which is going to add further government spending, further deficits. So in the short term, that's going to actually add to growth. I mean, we'll likely revise our forecast upward slightly next month to account for that increase in government spending. But on the other hand, it does put more upward pressure on corporate, mortgage, and government interest rates. And the capital pool can only be so large. So having all of that borrowing activity is going to hamper growth to some extent, though it should be noted that by historic standards, interest rates are still relatively low. A 2.8, 2.9% 10-year yield is higher than we've seen for most of the periods since the Great Recession, but is still nonetheless low if you go back 30, 40 years. One other factor that's helping in terms of keeping that U.S. outlook strong is the fact that globally, as Ottoman mentioned, you have strength in mature markets. Those are key trading partners. That's going to help U.S. exports. And at the same time, the strength in those economies are helping to keep the dollar weaker than we might otherwise expect, given the strength of the U.S. economy. So that's making exports more competitive. But inflation, as was shown this morning, is showing signs of firming, not growing incredibly rapidly, but significantly enough that the Federal Reserve may potentially increase interest rates 4 rather than 3 times during this year. And those expectations of rate hikes, they played a role in causing interest rates to move higher. And so that's going to act as a constraint on investment going forward and mute some of the positive impact on investment in terms of the tax cuts, and also potentially have an impact on housing markets as well.
Yeah, you actually answered my question, which was that for a long time in this recovery, we were really relying on consumer spending. And just last year, we've begun to see more capital spending going up from the business side. And that's kind of a normalization of the economy. But with the interest rates rising now, how worried are you about that constraining the business spending that's just beginning to return?
What you have to remember, Ottoman, is that we're in a unique epoch right now. We are engaging, the U.S. economy is engaging in fiscal stimulus at a time when the economy is doing quite well, and we're in the late stage of an expansion. So the result of that is that whereas fiscal stimulus has a higher multiplier effect, it causes more economic activity to occur when there are lots of labor and capital resources not being used, high unemployment rates, low capacity utilization rates. That's going to have more of an effect in terms of fiscal stimulus than at a time like now when capacity utilization rates are high, unemployment rates are quite low. So as a result of that, there is going to be heightened interest rates. And that's going to hit not just businesses, but also the housing market as well. We're already seeing 30-year mortgage rates rise, and that's going to reduce the number of potential homeowners who may want to get into the housing sector.
So it sounds like we need to be vigilant about what's going on, especially in response to some of the new policies that are coming in online in this environment of continuing robust expansion in the economy. And one of the things that we look at to see if there are changes in direction in the economy is the leading economic index, or the LEI. And earlier you saw the global version of this, the global aggregation, and this is the LEI growth rate for the US. And you can kind of clearly see that cyclical pickup there. It's in, comfortably in expansionary territory. And the red line is a companion coincident index, which tells us about the current conditions. And again, kind of an average growth rate over the business cycle. No significant sort of sign of risks or imbalances developing, but these developments, with interest rates rising, businesses thinking about pulling back, even though right now it's a good time to do it, undertake investments and business spending with the low interest rate environment, that's beginning to change. And some of the early signs will show up, whether that's going to lead to a change in the direction of the US economy. Although we don't see that right now, a lot of the leading indicators were built in the mid-20th century, and they're focused on the industrial and manufacturing sectors. So they're looking at construction activity, they're looking at new orders in manufacturing, they're looking at sort of unemployment claims and housing permits, and it's a pretty good, strong signal, especially for the industrial sectors of the economy. What we're struggling with is covering the services activity in the economy, and services in the activity has taken a much greater role in the U.S. economy in mature markets. That's why we call them mature economies, right? They're less reliant on manufacturing and more reliant on services. So one of our research projects is to look for new services indicators so that we don't mismeasure the U.S. economy and the business cycle developments. And because the coverage of the services sector is less in the LEI, I think we need to kind of interpret the signal carefully. And we do look for new indicators of services. And so we've worked with you, James, and Legal Shield data to kind of get a new view of those types of indicators. What type of legal services do you cover in your this new data set?
Yeah, and these are the top 15. I'd take a step back and say we cover over 70 areas of law. So when I say we get 1.7 million intakes a year, they're distilled into over 70 unique areas of law. And to give you the audience broader context, we basically what we did to create this, what we call the Legal Shield Law Index, is we took over 15 years of our history. We took it to an outside firm, and literally our CEO, Jeff Bell, said, what would happen if we took our data set, went to an outside economist group, and had them examine it? They looked at our 70 areas of law, they distilled it down and said, there's a set of 30 or so that make a lot of sense to look at from an economic perspective. And as we ran through battery of tests and looked at them, we came up with a few that made a lot of sense. And what you have on the page is the top 15. The ones that go into the economic index comprise over 80,000 intakes a month. Okay, and so some of the ones you see here represent them. So when we talk about, for example, the Consumer Financial Stress Index, that's composed on a monthly basis of our bankruptcy, foreclosure, and estate planning legal assistance. Right, those are real-time calls every day on consumers calling and saying, I have a potential bankruptcy I'm going to start, a foreclosure I'm going to start, some estate planning I need to start. And those things give us near real-time data on what's happening.
So when they ask for legal services, so that request is kind of categorized into one of these, you said 70, 80 different areas. And many of them, and these may be the most relevant of them, but they're related to economic activity.
That's exactly right.
So getting a close look at that actually is very helpful to think about, is there something changing in how that economic activity is evolving over time? And so it's a very sort of rich data set, and we found. Just to be clear, the conference board didn't do that work. You did that with another firm, and then kind of we met up and saw that this is very interesting in terms of leading indicators.
Yes.
And so let's show some of that evidence to our audience. And you've come up with a way to kind of group some of those activity indicators into Consumer Financial Stress Index.
Correct. So I'll talk about both of them. So the Consumer Financial Stress Index, as I just talked about again, is a real-time, gives you a near real-time view of consumer financial stress. It's inversely correlated with the consumer confidence that you obviously produce here. And as we've been sharing with the conference board since, I believe, June of last year, right?
It's been a while,
and we found it has a 1 to 3 month lead time because it's near real time. We collect it on a daily basis. We can produce it weekly or as often as we'd like to. And because it's hard data, meaning a consumer is taking actions, right? So it's not just sentiment, it's what is actually happening. We believe that hard data, again, gives us that lead time. And again, it's comprised of bankruptcy, foreclosure, and estate planning. And so that's what the consumer financial stress is. On the right side, you have the housing activity index. And the housing activity, again, is compared to the U.S. Census data. And same thing, 1 to 3 month lead time. And again, near real-time data relative to what's happening on the housing side from a foreclosure perspective as well as a real estate perspective. And those are the two major composite indices that we produce on a monthly basis.
I'm really fascinated by these numbers, how closely they correlate with other leading indicators. So that really corroborates the story that they are really picking up something about the economy, and that high correlation over time is very useful to see, because you can then kind of say with more confidence about whether the dynamics in the business cycle is changing or not. The data only goes back so far, and maybe as we get more and more data, and especially if we go through further recessions, it'll really confirm these as leading indicators. And who knows, maybe one day it'll become part of the leading index, because it does help us to cover that services.
I agree with you. There's 2 points I noticed. If you look back at the cycle in 2008, right, one of the things we noted, and it was real important to us when we 15 years of data, is that when that cycle occurred, and at that time I was working in the credit card industry as an example, a day's time and understanding whether you pulled back credit was worth a tremendous amount of money, right? We remember back then. We believe we would have called that that period of time probably about 2 months sooner, based on what we saw in terms of activity happening at the time, right? From a consumer financial stress perspective, because of the lead time of what actions were happening with those consumers, with their lawyers, in terms of our law firms. Right now, for example, people are asking us, well, what are we seeing because of tax reform, right? It's too early for us to make any conclusive statements, but what we can tell you without a doubt is that for January, we saw more estate planning calls than ever before, or at least since back to, if I look at my notes here, from an estate planning perspective, since the passing of the Tax Cut and Jobs Act, we've seen more estate tax calls than the highest level we've had in nearly 4 years. So that's an indicator, right, that people have a reason to believe that those two acts that have passed have a significant impact on them, and they're calling their law firms as a result of that.
And your indicators are also in line with the consumer confidence that the conference board puts out. We don't have a comparison here, but you can kind of see in both sets of indicators why consumers are optimistic. And that does kind of have a feedback into their spending patterns and plans. How are the consumers looking in 2018, Brian?
So I think one key thing in terms of thinking about consumer confidence relative to consumer financial stress is the presence of those foreclosure and bankruptcy numbers. Because what consumer confidence is doing on a month-to-month basis is it's taking the temperature of our survey panel. How are they feeling about their job prospects? How are they feeling about their personal finances? So during a period of expansion, it will continue going up. It also provides a potential early warning signal, as you can see going back to around 2007, leading to that contraction. One of the great things about the legal shield indicators is that they are, like our LEI, a dashboard of indicators, and some of them are better at calling downturns, some of them are better at calling upturns. So in the case of the Consumer Financial Stress Index, what you've seen recently, what you saw before the recession was a very precise call in terms of the downturn, is you had those bankruptcies, you had those foreclosures. As you get deeper into an expansion, those bankruptcy and foreclosure numbers tend towards almost zero. So as a result of that, that's why you've seen a flattening, which shouldn't necessarily be an interpretation that consumer spending is on the wane. What we're seeing in terms of consumer spending right now is that consumers are definitely confident. On the other hand, savings rates are remarkably low. So without further assistance, consumers simply can't spend all that much more money. However, there are two potential sources of spending assistance. First of all, there's the tax cuts, which will add to disposable personal income. Second, there's the continued possibility that as labor markets tighten, wages may increase. That could also provide more spending power. So that's why we see, even though savings rates are remarkably low, which shows just how much abandon consumers are currently spending, nonetheless, we do think that a near 3% growth in terms of consumption activity can be maintained at least through 2018. One potential risk area is inflation. What we're seeing in terms of inflation right now is that both of the major measures for inflation, the personal consumption expenditure price index, excluding food and energy, and the CPI, which did go up substantially today, but is still below that 2% target that the Federal Reserve seeks to shoot for, seeks to keep inflation around. Both measures have still remained relatively low, and I think it's important not to overstate the degree of concern in terms of these labor market supply constraints. What this green line shows is the difference between nominal and real interest rates over the next 5 years. So it's a measure to capture what do markets think inflation is going to be on average over the next 5 years. And still they think it's going to be right around 2%, though it has definitely increased. Part of that is an expectation of increasingly intense Fed action, but part of that is also a recognition that even though labor markets are tight, maybe there's greater upward wage pressure. Nonetheless, there has been a struggle to raise wages and prices throughout this expansion. And so there's not an expectation that inflation will shoot up that quickly.
But those expectations could change very quickly. And in addition to the labor market tightness, which pushes up the wages, it's good for consumers. The weak dollar is potentially a source for inflation, as well as energy prices going up. So if we see more volatility and especially upward pressure in energy prices, that'll begin to kind of see the observed inflation up, and that could push up expectations as well.
Absolutely. And indeed, I mean, with the CPI numbers, there's likely to be further increase just because March last year was a weird month due to cell phone prices, believe it or not. And that's going to move out of the data. So the CPI numbers will likely firm to above 2%, but I wouldn't expect sort of a rapid increase, especially if the Fed continues to indicate that it may potentially raise rates 4 rather than 3 times next year. And I think we can see what is happening in terms of market volatility and interest rates in this chart. You have the 10-year Treasury rate, which is hitting its highest point since in the last 2 years. And those expectations of Fed action, that's been an important source of market volatility. So that's definitely been an issue in terms of assessing market risk. Now, what this chart shows are two measures of financial risk. We've mentioned the Legal Shield Consumer Financial Stress Index already. We present here as well our leading credit index, which tries to provide early warnings about when conditions in finance, when credit conditions are beginning to tighten. And you can see that both of these measures show relatively tame credit conditions. And that's,
So if they're above zero, they're
right.
in kind of expansion, and they show that the business cycle is improving. And when they go below zero, they start to kind of signal that there's something going wrong.
Mhm.
Exactly. So they're showing those relatively tame financial conditions for right now.
Yeah.
But
Sorry, Brian. One difference is that while the Legal Shield Consumer Financial Index is focused on the consumer side, the leading credit index has both the market view about investors' confidence and the financial system more broadly from the business side as well. So you see two sides of it.
Yeah, and the financial stress index has some different components. We saw in January, not to set any alarms, a higher bankruptcy rate than we normally have seen, right? So we saw a higher bankruptcy rate, highest point since September 2015. So that made our financial stress index bounce a little bit. So not of alarm's sake, but that's what pushed us up a little bit.
Right. It doesn't seem like it would be enough to kind of shift the whole economy.
Exactly.
But it's maybe an indication that something's going on with those bankruptcy
Which
rates.
is another reason we say, consumer confidence should be up, but shouldn't be overstated.
Yeah.
Which kind of goes back to the main point.
But there is another area of risk that I want to address that the Legal Shield indicators are identifying. And we've started to hear more about subprime mortgages in the auto industry. And so could you tell us a little bit about what you're seeing in terms of increased risk in financial markets and for the auto sector in general connected with financing conditions and where those are playing out most prevalently?
Yeah, so last year, from our work we've seen, that the auto industry finally, saw a decline in sales, right? I think at 17.2 million in sales is, you would say post-hurricane surge is still a lot of sales, but it's a decline since the recession. And some have argued that this slowdown is really a pullback, and a lot of it's in the subprime auto loan sector, right? And so the auto loan sector is kind of setting itself up for a bubble and a break, right? Now, some would say it's not going to be as bad as the Big Short because it's not as big of an economic bubble. But nevertheless, we're seeing problems, particularly in the South, right? And our intakes also bear that out as well. So when we look at the intake volume, there are a lot more intakes in the South relative to auto delinquency, and the 90-plus day delinquency rate is well over double that in the North. So that's what we're seeing in terms of our intake volume.
And I think that's a really important finding because one of the reasons why this expansion has been able to be so long is that consumers after the Great Recession were bluntly spooked. They were worried about asset prices, most notably home prices, possibly falling again. They needed to repair credit balances. And so as a result, there wasn't as much borrowing in the years after the Great Recession as there was before. But this is a signal that perhaps consumers, as they become more confident, are becoming a bit less conservative than they had previously been, and that there may be broader consequences of more risky behavior.
Well, and I'll tell you too, and this is kind of an offshoot, but not really. The challenge with the subprime auto loan too is not just the pricing of the percentages, it's also the terms and durations, right? One of the things is the loans have gotten pushed out much longer. So what used to be 48 months, 60 months now, 72, 84, 96, right? And even some members of Congress have noted that in some of our visits that it's tremendously concerning to them of how much lenders are willing to push out the loans. And so there's a lot of concern already in the market.
I mean, one thing that's notable about sort of extending those, the length of those loans is that a lot of cars are not even used for that length of time. So that shows a potential imbalance there, that you could have cars being financed after their their use life has ended. Though it should be noted that the average age of cars on the road has continued increasing even during the expansion. It's up now to around 11 or 12 years. So that's a signal that some element of those extended loans may just be that car quality has gotten better, and as a result, maybe an extension of loan length may be appropriate. But I think nonetheless, it's something to be concerned about. You also talk about using the real estate index to assess current housing market trends. And when I think about housing market trends right now, I'm thinking about a couple of things. So on the upside, there is still a lot of pent-up demand because of delayed household formations associated with the Great Recession. That's a major upside. A few downsides are that the mortgage interest deduction changes under the new tax laws are going to make it more difficult at both the low end and the high end for individuals to finance homes, because they're going to either be subject just to the standard deduction, or they'll be limited in how much they can take out in terms of the mortgage interest deduction. So that's one factor. Then another factor is just, even though demand in the construction industry may be relatively high, the number of workers available is quite small. You have a large number of unfilled vacancies. So what is this chart telling us about current trends in real estate intake, and what it says about the present and future condition of the housing market?
Yeah, well, a couple of things. One, we saw foreclosures really get more subdued, which is good. They're kind of more flat to marginal, which is great. And again, we were talking about this before it started. Last year, we thought housing started should have really rebounded, right? But they were really subdued, and we think a lot of that was due to input prices. So hopefully that's kind of subdued, and now we're starting to see it come back. I think the NAR for this year has predicted 3.4% growth, which is excellent. We've seen thus far the South have really taken off in housing starts for this year. And from what we've seen over the last 6 months, 5% year-over-year growth in the South is what's happening, relative to 2% national growth, right? That's one of the things that's happening. Additionally, we've seen 12.5% year-over-year growth in our insurance AOL, right, area of law, which means that's just a lot in terms of new people getting insurance for homes in the insurance AOL. So we're seeing that, and again, after hurricane season, which we had 2 in August, right? We had Harvey in Texas and Emma in Florida. People are getting back to getting homes quickly and rebounding and getting families back together, et cetera. And so it's excellent. Texas insurance intakes remain 30% above year-ago levels in November of 2017, which just shows a fast rebuild. So people getting back to work, builders back to work, and people selling and supplies and such all around that. And so we're really seeing the market come back in those areas.
And one incredibly valuable feature of these indicators, especially the insurance claim indicators, is the ability to, in real time, assess the effects of a storm on insurance claims. So what did we see this September with Hurricane Harvey, and how does that compare with past storms and how they affected insurance claim data?
I mean, really, we saw just, the data from a data perspective, people react quicker and turn in claims quicker. I mean, it's really what we saw, and people get back to building quicker. I think previously, and we are still, I think, looking at the data to understand the whys, but we saw people not react as quickly in terms of turning in the claims and getting back to building and reoccupying space, right? The whys are still a question mark, but what we're seeing, people rehabilitate those areas much quicker this go around.
Yeah, in general, when you look at leading indicators to track the economy and the business cycle, the economy is constantly getting hit with these types of shocks, right? It's a natural disaster or something else, and it can be large enough to kind of impact the overall economy. But generally the underlying trend returns after a few months, 2, 3 months. You kind of go back to whatever the fundamental trend of the economy is. And if that's healthy and strong growth, it means that you get this bump along the road and you go back.
Right.
And these numbers also help us to kind of get that assessment. I think that's very useful to get a more granular assessment to when we're wondering about, while the economy is sending mixed signals, we think the trend is positive. It's showing growth. Will this natural disaster going to hit us down to go down into the contraction pack? We can look at numbers like this to get a better assessment whether it's going to be temporary or not.
Right.
And that speed of response comment that you made is also very interesting. That in comparing these different episodes, you get kind of that comparison about the importance of it for the affected people.
And what one of the things you're making me think about, Brian, is we have an AOL around different businesses as well. One of the things I'd love to do now that you have me thinking about is looking at some of our construction AOLs and our business AOLs, right, and seeing how those tie out in those specific areas, because it'd be great to see if the contractors, how those things all line up, and we can see the data play out in sequence in those areas as well.
No, I think that would be a very interesting application of the data, because when we think about the impact of the tax law, I think a very valuable application of some of these data sets is the ability to, in real time, see how an event changes behavior. I think looking at businesses rather than, as we were discussing earlier, looking at estate planning might provide valuable insight, because when you look at the tax plan, a lot of the incentive is in terms of investment is going to be towards investing in hard assets, in equipment, in large business structures such as warehouses. So to the extent that you would be seeing residential construction, that would obviously be an important indicator for housing. To the extent that you'd be seeing non-residential construction, it would be an important indicator for business investment. So I think that's a really good approach to how else we could use these indicators. But in terms of thinking about quick responses, one other area where we've seen this kind of quick response is around the Equifax data breach.
Sure.
Could you talk a little about that?
Yeah, I don't know if I even need to say anything. So,
it's obvious.
Yeah, so last year, as you know, we had the Equifax data breach where over 145 million people were potentially impacted with the breach of data. And you can immediately see on the chart, when that data impact happened, the number of intakes just spiked immediately, with people calling about two areas of law, identity theft and credit repairs and reports. And people called to make sure their identities were protected. We also carry as a company the second largest product, which is called ID Shield, and we had no lack of problems, no lack of sales in those months of our ID Shield product. But also people want help with their credit reports and repair. And that carried, you can see, on there, and then trailed off once folks felt more comfortable. Yeah.
And this is all kind of part of the social infrastructure of the economy, right? And you can kind of pick out things, trouble spots, and whether the virtuous cycle is continuing or not, or whether it's going to hit a bump in the road or not, and from where that is going to come. Exactly. Is it going to be cybersecurity, or is it going to be housing? So this is a very innovative data set.
Yeah.
I want to thank you for sharing that with us and with our viewers. And I'm sure that we'll be referring back to it, and maybe we'll have you back on again. But unfortunately, we've come to the end of the hour.
Absolutely.
It was a great discussion. I want to thank Brian Shakin, our senior economist, and James Rousseau of Legal Shield. Thanks for being here. And this is the end of the Economics Watch webcast. I'm Ataman Özyıldırım with the Conference Board. Thanks for joining us.